Hey everyone, welcome to today's Explainer. Today, we're unpacking a state of absolute market confusion, tracing the chaos from central bank policy all the way to crypto's surprising resilience. If you've been looking at the markets recently and just kind of scratching your head, well, you are definitely not alone. The overarching theme of our analysis today is that the markets are in a state of complete disarray. We're going to break down exactly why that's happening.
So, here's the game plan for today's Explainer. First, we'll look at the Fed's new era. Second, the AI trade, specifically Meta versus Microsoft. Third, South Korea's massive leverage meltdown. And finally, number 4, crypto's resilience. Let's just dive right in.
Section 1. The Fed's new era and the ensuing market confusion. Let's jump straight into the macro level, starting with the overwhelming uncertainty surrounding the Federal Reserve. Because, as we all know, if there's one thing markets absolutely hate, it's confusion.
The source data really perfectly quantifies this confusion, tracking these just massive multi-trillion-dollar intraday swings on the S&P during the recent FOMC meeting. I mean, look at this whiplash. At 9:30 a.m., the S&P falls 85 points. That wipes out $770 billion. Ouch, right? But then, a few hours later at noon, it rallies 110 points, slapping a cool $1 trillion right back onto the market. And then, by 3 p.m., it drops another 120 points. So in a single-day session, we saw 3 huge swings totaling a negative $2.9 trillion. These numbers prove just how deeply confused the markets are, wildly swinging back and forth as they try to digest the Fed's messaging.
Now, a lot of this extreme volatility stems from recent statements by Fed Chair Kevin Walsh. He actually called for a task force to revisit the reliability of the very data, both public and private, that the Federal Reserve uses to make its decisions. Think about that for a second. It's a pretty incredible admission. He's effectively forcing the market to price assets using the exact same data that the Fed is actively questioning. It's like the Fed is essentially saying, hey, we're going to let you participants decide the pricing based on this info, but we don't actually know if we trust it ourselves. It completely removes any sort of clear forward guidance from the equation.
Analyst 𝗗𝗶𝘀𝗰𝗋 really hit the nail on the head here. He argues that the Fed operates less as a unified voice these days and more like a pure democracy. You know, back in the day, the markets simply listened to Chairman Powell, right? His voice represented the entire Fed. But today, it's a total guessing game. You literally have to look at all 12 voting members and tally up which columns they fall into, like who wants to hike, who wants to cut. It's become this complex voting exercise that just adds another massive layer of uncertainty to an already confused market.
So, the really crucial takeaway from the source data here is the glaring disconnect between official policy and what the market is actually doing. The official Fed funds rate was left totally unchanged at 3.5 to 3.75%. But, get this, the 2-year yield is currently sitting way up at 4.2%. Because the Fed is kind of stepping back and letting the market do the pricing, the market is breaking away from that official guidance. If things keep up on this trajectory, the data indicates that the market is actually starting to price in a potential rate hike, rather than the cuts everyone was so desperately hoping for.
Okay, moving on to Section 2, the AI trade, focusing on big tech earnings with Meta versus Microsoft. Because while Wall Street is busy trying to read the tea leaves at the Fed, Silicon Valley is facing its very own reckoning, specifically concerning the massive capital expenditures that are driving the whole AI trade.
We're seeing a stark divergence in big tech earnings right now. Both Microsoft and Meta are massive spenders on AI capital expenditures, but the market's reaction to them is completely split. Microsoft reported higher than expected earnings and revenues, and the market absolutely rewarded them with a massive 15% jump. Meta, on the other hand, they missed their earnings per share expectations, coming in at 6.18 versus an expected 7.19, and man, they were heavily punished, dropping 10%. It just shows that the AI trade isn't acting uniformly anymore. It is highly dependent on actual execution.
And hey, when we talk about Meta's execution, we absolutely have to talk about this staggering number, $87 billion. That's billion with a B. That represents Meta's total reported loss in its Reality Labs division alone. You know, the team tasked with building the metaverse. According to the source, they recently lost another $4.6 billion, which just adds to an already monumental deficit for a single division inside the broader company. So naturally, Meta's aggressive CapEx spending, especially when combined with their low free cash flow, is severely spooking investors. Meta generated just under $1 billion in free cash flow recently, and yet they're continuing to pour these massive amounts of money into AI and reality labs. There's a fundamental shift happening in investor expectations here. We used to rely on these tech giants to reliably pay out dividends and execute share buybacks, but now they're pouring everything into endless investments, and as Meta's stock drop clearly shows, investors are losing their patience and they are demanding tangible returns.
Let's shift gears to Section 3, South Korea's meltdown and the ensuing leverage washout. We're moving across the globe now to see exactly how market exuberance meets extreme leverage to create a pretty severe cautionary tale.
56%. That is the massive, gut-wrenching drop from the peak for Hynix, a major technological giant in South Korea. To really understand the gravity of this, you need to know that Hynix makes up roughly 33% of the entire Korean stock market. So we're not talking about some small speculative asset here. This is literally a pillar of their economy. On its way up, it delivered incredible returns, but dropping 56%, that has absolutely devastated the folks who bought in at the top.
The source details how this brutal sequence of events completely wiped out South Korean retail investors in a classic, painful leverage washout. It's like a domino effect. First, retail investors chased the early rallies of the year by borrowing heavily on margin loans and using single-stock leveraged ETFs. Second, the broader market, including giants like Hynix, experienced a sharp, sudden dip. And finally, because these investors were playing with borrowed money, that exact same leverage forcefully wiped them out. It triggered a massive cascade of automated liquidations that just drove the entire market down even further.
The real-world impact of this washout is honestly incredibly severe. The source notes extreme distress among retail investors, explicitly mentioning that retail helplines are monitoring their callers on suicide watch. It is a deeply, deeply serious situation. In fact, the meltdown has been so violent that researchers are reporting rumors of regulatory intervention. Specifically, South Korea is reportedly considering banning short selling entirely to try and halt the bleeding, which is a drastic move we often see in Eastern markets when volatility just completely spirals out of control.
All right, bringing it to Section 4, Crypto's Resilience. Immune to chaos? Let's bring it back home to the digital asset markets to answer a burning question. Is cryptocurrency actually immune to all this traditional finance chaos?
Well, as the source data brilliantly illustrates, crypto has significantly outperformed traditional equities during this specific period of macro turbulence. I mean, while the Korean Kospi index melted down 33% and the S&P 500 dropped 2% amid all that Fed confusion, Bitcoin actually trended upwards, gaining 10.2%. It really looks as though the digital asset market almost preempted the trouble in traditional finance, managing to hold its ground remarkably well.
The commentary points out that despite the widespread TradFi panic, Bitcoin remained remarkably unfazed by the FOMC meeting. It was sitting at around $64,000 before the interest rate news, and it held incredibly steady around $64,600 to $65,000 right after. Meanwhile, Ethereum actually surged, seeing some really notable gains, up to 21.8%. We're also seeing projects like the Near protocol starting to recover, which is aided by some unique tokenomics like burning 100% of their gas fees. Though, to be fair, many other altcoins definitely had a rough few days and still have a lot of ground to claw back.
But here is a fascinating irony unfolding right now. While traditional leverage is causing absolute meltdowns in Asian equity markets, the crypto space is actually leaning into it. The source notes that crypto exchanges, like Bybit, are newly offering high-leverage trading. We're talking up to 10x, 15x, and 20x on perpetual futures for tokenized versions of traditional finance stocks like Meta. So crypto traders can now speculate on TradFi assets with the exact same aggressive leverage they use for digital tokens. It's literally bridging these two incredibly volatile worlds together.
Ultimately, as the source analysis leads us wondering, we have to ask the defining question for the weeks ahead. Will digital assets maintain this surprising resilience and actually continue to make higher highs? Or are they simply waiting for the other shoe to drop, meaning we still have to ride out a broader stock market contagion before a true crypto bull run can resume? It is a giant, complex web of data, and frankly, it's entirely up to the markets to decide what happens next. Thanks so much for joining me for this explainer. And as always, keep questioning the data.